Good afternoon. It's Jeffrey Christian of CPM Group. It's a little after 4 o'clock in the afternoon here in New York on Monday, the 19th of February. I'm recording this for release on the 20th of February because I'll be out of the office on that morning doing some personal business. I had mentioned earlier in the year that I wanted to talk about quantifying commodities investments for investors, and that I would give a highlight of an overview, and then hopefully over the course of the year, 2024, delve into like the 6 questions that should be asked. I tell an anecdote about my early days, about my first day at Goldman Sachs. A very powerful and very intelligent and very successful investment analyst said to me that he thought of gold as a religion and not an investment. And I, in my naivete at the time, said, well, I think that for many people, gold is in fact a religion, but I think you'll be very impressed by the quantitative work that we've done that shows that you can quantitatively and intellectually invest in gold and other commodities alongside with stocks and bonds and currencies. He said he didn't think he would be impressed by our work. But I think over the last 40 years of knowing him, maybe he has become a little bit impressed. Now, I also tell an anecdote about meeting the chief investment officer of one of the largest pension funds, union pension funds in the United States. And this goes back to probably around 2008, when there was a whole lot of hype from banks and brokerage houses about the commodity supercycle. And those of you who have listened to us know, I think the commodity supercycle is nothing more than marketing hype. And what was going on from 2002 to 2011 was economics 101. It wasn't anything that was out of the ordinary. It wasn't a super cycle. It was certain markets catching up with other markets that had outpaced them for 10, 20, 30, 40 years. And it was all readily explainable with basic economics. She said, these banks and brokerage houses keep coming to me and saying, I should have commodities in my portfolio, but they can't tell me why. And I said, we can, CPM Group, that's what we do. And there are various reasons why an institutional investor should and can should have and can benefit from having commodities in their portfolio. She had 5 questions. She said, if you can answer these 5 questions, I'm your client. We added a 6th one. And I want to talk to you today about those 6 questions. Just put them out there and make a couple introductory comments. I don't want to deal with them in detail, but over the course of the year, maybe I come back in 6 different videos and deal with each one. First one was, how do you quantify commodity returns? There's this myth that commodities have no returns, and therefore you can't really quantify them and put them in a diversified portfolio with stocks and bonds and say, well, this is the return, this is the comparable return, and this is the comparable risk-reward ratio. That's not true. Commodities have returns. They have a variety of returns, and those are measurable, and you can calculate the risk-reward ratio, the historical returns relative to the historical price volatility, and you can compare that with stocks and bonds and currencies and other investments, including real estate. So that's the first question. The second one is, how do you value commodities? Well, there are clear, concrete, reproducible ways to value commodities. And it's actually very straightforward. These are not Bitcoins. They're not pet rocks. They're not internet startup companies in 1999. Commodities are easily valued, and anybody who has trouble valuing them needs to come to CPM Group and hire us as their advisors. Third one is, how volatile are commodity prices relative to other asset values? And again, that's readily measurable, readily quantifiable. And we've done that. We've done that work for almost half a century now, where you can compare the commodities prices relative to other asset values. And I'll just say one thing here. A lot of people measure gold or silver or oil relative to, say, the S&P 500 or the Dow Jones Industrial Index or some index of corporate bonds or other debt-bearing securities. And that's an inappropriate way of doing it. CPM Group falls into that trap too, because that's the way the market thinks about these things. But you're talking about gold or silver or oil, you're talking about a single asset. Talking about a Dow Jones Industrial Average, you're talking about what? Something on the order of 30 different assets that are being averaged. And with the S&P 500, you're talking about 500 assets that are being averaged. The volatility of averages of 30 or 500 or whatever you want, you look at the Russell 5000, the volatility of an average of a large number of assets will always be lower than the volatility of a single asset like gold or silver or oil. And if you want to have an accurate comparison, you should look at gold versus a stock, Microsoft, or our favorite Tesla. If you want to look at volatility and relative volatility, compare gold to Tesla. So volatilities are easily measured for commodities, and they're also easily compared to other assets. By the way, the two most volatile commodities historically, price-wise, are natural gas and silver, highest price volatilities. And there's a very interesting work that we've done at times over the years, which shows that whether or not a commodity is traded on a futures exchange doesn't necessarily indicate that it's going to be more or less volatile than a commodity that is not traded on an exchange. There are people who will tell you that trading on an exchange increases the volatility of a commodity's price, and there are people who will tell you that trading on an exchange decreases the volatility of a given commodity price. And the reality is that you can find examples that will justify and support both of those. But if you look at commodities across commodities, if you take maybe 30 or 50 commodities, some exchange traded and some non-exchange traded, you'll find it's other factors that determine the relative volatility of those commodities. It's not whether or not they're traded on a futures exchange. Are commodities good inflation hedges? Yes, they are. But you have to understand what that means. It doesn't mean that the commodity trades tick for tick with inflation. And you also have to say, well, which inflation are you measuring? It doesn't mean that it moves tick for tick. What it does mean is that, generally speaking, if you have commodities in your portfolio, the overall portfolio return will do better in inflation in the long run, facing inflation and disinflationary times, than a portfolio that doesn't have the commodities. How do investors generate alpha with commodities? Alpha and beta are the fancy way of saying profits and wealth preservation. There are many ways to profit from commodities investments, and it's not just buying low and selling high. Buying low and selling high makes sense, but there are many other mechanisms available to savvy, intelligent, quantitatively based investors in which they can generate alpha with commodities. You don't just have to be savvy and buy low and sell high. And the sixth question was, which commodity indices should be used in research measuring commodities performance? And the answer is, well, you should use a number of commodities prices, but CPM Group uses the CRB index. And we use that. That's been around since 1957, 1958. The Commodities Research Bureau built it. and maintained it. It's gone through several ownerships. I believe Jeffries might now own the CRB index. But we use that one. It was created by economists and market analysts to be objective. There are many other commodity indices that have been created by other people in order to prove a point. I want to show that overall commodity prices have a better relationship with inflation or a lower relationship with inflation or mismeasuring inflationary pressures. And so they'll skew the contents of the index to justify their conclusions. And there are others that have you have to be very careful because oil and energy represent such an enormous portion of the value of commodities. And if you're not careful and say, if you put in WTI and Brent oil prices, you skew the index value to be heavily weighted in oil and energy, and you miss a lot of other factors that are there. So those are the 6 big questions. If you want to intelligently invest in commodities and you want to use the quantitative tools that are available to get away from the belief system, those are 6 big questions to address and understand and embrace in order to do that. Hopefully, over the course of the rest of the year, we'll be able to explore each of those in greater detail. CPM next week on February 28th will be doing its facts and fantasies on silver. You're welcome to join. You can go to our website and find a way to join it. I just click here to sign up. Hopefully we'll put a link in on this YouTube that will allow you to do that. At this point, it's probably going to be about 2 hours long, and we have more than 100 questions that people have sent in ahead of time for us to address. Other people will be allowed to send in questions during the webinar, online seminar over the period of time. We've got that coming up. We've got our PDAC silver reception. And then March, May, July, we'll be coming out with our yearbooks. And we still hope to do a silver seminar in October in Spokane. That's all I have for now. You can go to our website, learn about other things. You can send us an email at info@cpmgroup.com. Take care of yourself. Take care of those around you. Be good to the world. And we'll talk to you later this week.